Hi everyone, I'm Russell Muldoon from Montgomery Investment Management. Happy New Year and welcome to this week's Video Insight. Well, with many companies now in what we call the blackout period in the lead up to reporting season, and have already posted this year about two businesses with very bright prospects that we hold in the Montgomery funds in TPG Telecom and Certex. This week we'd like to talk to you about a little bit about investing in 2014. Now, for many investors, the share market seems daunting and impossible to understand. One day, it's down on fears that interest rates might rise, that economic growth may falter, all because commodity prices fall. The next day, it's up for the very same reasons it was down for the previous day. It can be very confusing. Now, in our experience, this confusion amongst investors exists partly because of the human tendency to want to complicate matters. That and the fact that many experts being relied upon on a daily basis simply end up being wrong. The tendency to make simple things difficult, coupled with an avalanche of daily news to be distracted by, ensures obfuscation rather than clarity of the environment which many investors find themselves operating in. Of course, it doesn't need to be this way. Our investing framework at Montgomery Investment Management is the result of the application of the KISS principle. Creating a simple framework that every member in the office can appreciate helps us to deliver the satisfactory returns we have achieved over the past 3 years. And when we boil it down to, there are really only two key parts worth focusing on. Firstly, and most importantly, we must buy businesses within our circle of competence. And then, from those, only those businesses with the brightest prospects. It's fair to say that while successful share market investing is not easy, intelligent investing is not complex either. There is room for many to do well in the market, and you don't have to be an expert on every company, or even many, to succeed over the very long run. All that we think is required is the ability to evaluate companies within your circle of competence. And the size of that circle is less important than knowing your circle's boundaries. Once you understand and can appreciate your limitations, simply avoid the temptation to stray outside your circle and then only fill your portfolio with businesses that you understand. The benefit of such discipline is that you will know if your companies in your portfolio and you're considering buying have bright prospects for the future. The second element you need to think about is share price volatility, and think about it correctly, which is perhaps the more difficult of the two. Even before you begin to build a portfolio of businesses, you need to accept that your returns will rise and fall with the share market, and if you choose to watch share prices swing around on a daily basis, in turn, their impact on your portfolio, your emotions will constantly chip away and dismantle your investing framework, leading to poor decision making. If you have done your homework, and indeed truly understand that what you are buying or what you have bought complements a portfolio of businesses where you're virtually certain those earnings are going to march up over the years, then rather than getting emotional, make share price falls or price volatility a time of joy and not a time to be panicked. In 2014, turn off the market's daily noise and instead go about ensuring that the businesses that you own or are looking to buy are first class, and if not, simply hold cash until you find suitable opportunities. Well, that's all for me this week. Please remember to follow us on Facebook and Twitter, and make sure you keep a close look out in 2014 for our investment opportunities that will be sure to come our way. Have a great year.